Welcome to FintelliQ, where we unlock the secrets to advanced financial intelligence. Today, we are tackling a paradox that plagues many successful professionals: the illusion of wealth. You are earning a six-figure salary. You are at the top of your game. Yet somehow, true financial freedom feels just out of reach. You might be even be living paycheck to paycheck. Sounds familiar? The truth is, high income doesn't automatically translate to lasting wealth. In fact, it often comes with its own unique set of financial traps. In this video, we are going to expose the 10 budgeting mistakes that keep high earners broke and, more importantly, equip you with the strategies to avoid them. This is not about cutting out your daily late, it's about optimizing your financial ecosystem for true and long-term prosperity. Let's start with what we call the high earner paradox. Many believe that simply earning more than the more money solves all financial problems. But statistics tell a different story. Nearly 40% of high income earners, those making six figures or more, report living paycheck to paycheck. This is not a problem of insufficient income, it's a problem of insufficient financial management. The core issue is the distinction between being income rich and asset rich. You can have a fantastic cash flow, but if that cash flow is not being strategically converted into appreciating assets, you are essentially on a financial treadmill. Our goal today is to help you transition from merely earning a high income to building substantial net worth. The first and arguably most insidious mistake is the lifestyle inflation trap, often known as lifestyle creep. As your income rises, so does your spending. That bigger house, the luxury car, the designer wardrobe, the exotic vacations, they all became the new normal. This phenomenon is driven by what psychologists call the hedonic treadmill, where actually increased pleasure from new possessions quickly fades, leading to a constant chase for the next upgrade. The problem is not enjoying your success. It's when your expenses rise at the same time as your income, neutralizing any wealth building potential. And here's the strategic fix. Implement the 50% rule. For every raise or bonus you receive, commit to investing or saving at least 50% of that increase before it even hits your checking account. This simple discipline ensures your net worth grows faster than your spending. Next up, insufficient tax management. Many high earners focus intensely on their gross income, but they often overlook their largest annual expense, the taxes. Failing into strategically manage your tax liability is like leaving money on the table. Year after year, are you maximizing tax advanced accounts like backdoor growth, IRS, health saving accounts, AGES, and or your 401k? These are not just retirement vehicles, they are actually powerful wealth building tools that offer significant tax benefits. An HSA, for example, offers a triple tax advantage: tax-deductible contributions, tax-free growth, and tax-free withdrawals for qualified medical expenses. The strategic fix is to treat taxes as a controllable expense. Work with financial advisor to optimize your tax strategy, ensuring you are utilizing every available avenue to reduce your taxable income and minimize your after-tax wealth. Don't just pay taxes, manage them. Now, speaking about the RSUs and the bonus gamble, for many professionals in high value sectors, a significant portion of compensation comes from restricted stock units or RSUs or annual bonuses. The third mistake is mismanaging variable income, often treating as this as found money or windfalls. This management leads to the two familiar major pitfalls: errating spending and over-concentration. If your salary, benefits, and a large chunk of your net worth are all tied to a single company's stock, you are exposed to immense risk, and a downturn in your company's fortunes could devastate your entire financial picture. The strategic fix is to adopt a sell-on-vest policies for RSUs. As soon as the vest, sell a portion or all and diversify those funds into a broad market portfolio. And here's a pro tip: budget based only on your base salary. Use bonuses and RSUs exclusively for long-term wealth building, debt acceleration, or significant investment opportunities. They are compensation, not a lottery win. Our fourth mistake is a silent killer: the cash drag phenomenon. While having an emergency fund is crucial, many high earners keep excessive amounts of cash in low-yield saving accounts. In today's inflationary environment, this is a guaranteed way to lose money. Inflation erodes your purchasing power, turning your idle cash into a depreciating asset. This isn't just about missing out on potential gains, it's about actively losing value. This represents a significant opportunity cost. The returns you could have earned if that capital are invested wisely. Now, the strategic fix is to differentiate between your emergency fund and your opportunity fund. Your emergency fund should be liquid and sufficient for 6 to 12 months of expenses. Any cash withdrawn, any cash beyond that should be strategically deployed. Automate the transfer of excess cash into diversified investment vehicles, ensuring your money is always working for you, not just against you. Now, speaking of emergency funds, the fifth mistake is inadequate emergency fund scaling. The standard advice of 3 to 6 months of living expenses simply doesn't cut into for high earners. High income roles are often niche and competitive. If you are to lose your job, finding a comparable position could take significantly longer than for entry-level roles. Think 6 to 12 months or even more. Further, your fixed costs such as jumbo mortgages, private school tuition, and higher insurance premiums and substantially greater. A 3-month fund in this scenario is a catastrophic risk. And here's the strategic fix. The strategic fix is to scale your emergency fund to match your unique financial footprint. Aim for 6 to 12 months of expense held in a high-yield savings account. This provides a robust safety net allowing you to weather unexpected storms without compromising your long-term financial plan. Our sixth mistake is the good debt delusion. High earners often rationalize massive liabilities, think luxury car leases, oversized mortgages, or high-limit credit card balances as strategic leverages. They believe that because they can afford the payments, it's a smart financial move. But there's a debt trap. When your debt to income ratio exceeds 35%, you are not actually leveraging wealth, you are financing a treadmill. In reality, over leveraging for lifestyle assets creates a fragile financial foundation. It ties up capital that could be invested, and it relies on an uninterrupted flow of high income. When your debt to income ratio creeps above 35%, you are not leveraging wealth, you are financing a treadmill that keeps you running just to stay in place. Now, the strategic fix for that is to redefine the good debt. A true debt is an investment that generates income or appreciates in value. Prioritize debt-to-income ratios that free up capital for aggressive investing. Treat any debt that doesn't produce income as a liability. Be managed, not merely managed. Now, we are combining two related mistakes here: siloed financial planning and underestimating invisible costs. Many high earners manage their investments, taxes, and daily spending in isolation. They fail to see how one financial decision impacts the entire ecosystem. For example, a significant luxury purchase might not be an expense. It would push you into a higher tax bracket or delay your retirement timeline. Without a holistic view, you are making decisions in vacuum. Simultaneously, the affluence tax is real. Higher income often comes with higher maintenance costs, increased insurance premiums, professional fees for legal and accounting services, and upkeep for larger properties. These invisible expenses can silently drain your budget. Now here is the strategic fix. The strategic fix for both is integration. Create a holistic master financial dashboard that connects all aspects of your financial life, and for those invisible costs, proactive at a 15% maintenance buffer to your projected lifestyle expenses. This ensures you are accounting for the true cost of your affluent lifestyle. Now, our ninth mistake is falling into the golden handcuffs, relying solely on active income. Many high earners based on consumption assumption that their high salary will persist indefinitely. This creates a dangerous dependency. What happens what happens if there's an industry downturn, a layoff, or a health issue that prevents you from working? If your entire financial structure is built on your active labor, you become incredibly vulnerable. True financial freedom is not about how much you earn, it's about whether your assets can cover your lifestyle independent of your labor. The strategic fix is to aggressively pivot from active income to passive diversification. Budget for your assets to eventually replace your salary entirely. This means prioritizing investments that generate passive income streams, giving you true autonomy and resilience against unforeseen circumstances. And here's finally the 10th mistake is the set and forget error. Many high earners create a financial plan, set up their investments and then rarely visit them, but financial plans are not static documents. Market conditions change, tax laws evolve, and your personal goals shift. Falling into conduct regular reviews means you are missing critical opportunities for rebalancing your portfolio, optimizing your tax liabilities, and adjusting your strategy to align with your current life stages. This oversight can cost you millions in lost potential growth. Now, the strategic fix is to implement a quarterly financial audit. Treat your personal finances with the same rigor as a corporate treasury review. Regularly rebalance your portfolio, review your tax strategy, and adjust your lifestyle buffer. This proactive approach ensures your financial plan remains dynamic, optimized, and aligned with your long-term wealth goals. Here we have covered the top 10, not exactly the top 10, but 10 critical budgeting mistakes that can derail even the highest earners. From lifestyle creep to neglecting systematic reviews, these pitfalls can prevent you from achieving true financial freedom. Remember these three pillars: the audit your current financial habits to identify your blind spots, automate your savings and investments to remove emotion from the equation, and accelerate your journey towards financial independence by building passive income streams. It's time to take control of your wealth. If you found this video valuable, hit the subscribe button and join FintelliQ community for more advanced wealth building strategies. We are here to help you navigate the complexities of high-income financial planning. We would love to hear from you which of these budgeting mistakes are you currently making or have you successfully overcome. Share your insights in the comments below. Your experience could help someone else on their journey to financial mastery. Thank you for watching, and we will see you in the next video.